clearly, Adrian, how are you?
I'm well, President Cannon. How are you?
Good. So clearly half our club has an appetite for risk and the other half we can broadly say does not. So it sounds like our conversation today is in a perfect setting. So for those of you who don't know Adrian, I know everyone knows Adrian. Adrian is CEO of Ballentine, an investment firm here in Atlanta, and certainly a great member of our club, done a lot for us in membership and other services as well. So Adrian, we're excited to have Jason, and we'll turn it over to you. We're in your good hands.
Thank you, Cannon. And let me start by welcoming you to the club, Kazuyuki-san and Ryan. I'm super excited to get to know you both soon when we can gather together. Jace, welcome to the Atlanta Rotary Club today, and thank you very much for your time. You know, our club members have already been sent your impressive background and resume, but that was probably not necessary. Given how regularly you appear on CNBC, Bloomberg, Fox Business News, and what have you, and how often you author op-eds for the Wall Street Journal and the Financial Times, many of us in the audience are already quite familiar with you. We're used to seeing you communicate in quick sound bites on TV and the press. And so we're looking forward to being able to cover some of the topics about the markets and the economy in greater detail today, as surfaced in the answers to that Menti poll. As Karen said at the outset, the overarching theme of our club's programs has been investing for tomorrow today. This is the first in a series of programs through January, focusing specifically on the component of defining the economic path in 2021 and beyond. So why don't you kick things off by spending a couple or 3 minutes setting the stage as we approach the end of a tumultuous year. On the day, we are learning of optimistic news that the long-awaited vaccine developed at warp speed is beginning to be distributed. 2020 is already being identified by many as a watershed year in world history, akin to 1945 and 1979, exposing deep-seated vulnerabilities and accelerating trends that were in place prior to the pandemic. Are we on the cusp of the roaring 2020s like we experienced 100 years ago in the 1920s, as some are describing the disruptive decade ahead of us? Maybe you can identify some of the long-term winners and losers from this global health pandemic.
Great. Well, Adrian, thank you so much, and thank you all for having me speak to your club today. I loved the Silver and Gold song, and I loved also the Pledge of Allegiance, which it's great. And unfortunately, you know, I do this sort of stuff a lot. Like before March, I did it for about 30 years on the road, and now I'm doing it virtually. But I also appreciate the ability to ask those questions because, you know, I've devoted my life to the study of economics and the markets. And one of the things I found, because I live and work in Manhattan, is that New York is for all the pretensions of being cosmopolitan, it's very provincial in its own way. And there's a curse of having to be on an airplane every week, or just about every week, you know, which is going through LaGuardia and Kennedy Airport and all the rest of it. But there's a great blessing in doing that and going around to see people. We have clients in 45 states and over 20 foreign countries, and we're constantly on the road to see them. And those questions that were asked, and I'm going to ask you for permission after this if I can use it in my own report, you know, those are the types of things I get enormous benefit out of. And we have a whole team of people here that look at government statistics and all the official stuff. And yet I find that the anecdotal part of this job is extremely important. And you can often get lost in kind of just official data. And sometimes you'd be better off just talking to people. And I think that gets forgotten a lot in this town. It gets forgotten a lot in Washington as well. So I just wanted to say thank you for all of that. If you don't mind, I'm going to take, I promise I won't take more than about 5 or 6 minutes. I just wanted to go through some very basic things, facts, before I get into the opinions, because everybody's got opinions. But maybe I'll show you some facts you might not know, and I think it might set the stage. I'll introduce a few opinions in there as well, and I'm going to show you. I have a PowerPoint here, and I'm going to show you page 2 for a minute, And if you want this, by the way, we can make this publicly available to you. But I just, a lot of what I do, I think I'm Catholic, so I'm used to catechisms, like more, questions and answers. And one of the questions I get a lot when I'm out on the road, or if you're doing this, virtually, is, how can the economy be so fragile in a way, and how can the markets be so strong? And I think one of the better answers to that is really just the bottom table of this page 2, which just shows you the differences between GDP and the S&P 500. The punchline is that GDP, if you remember from your economics textbooks, is consumption plus investment plus government spending plus net exports. And the S&P 500 is made up of 11 sectors. 27% of the S&P 500 is just made up of technology. And then if you were to add communications and financials and healthcare, you'd get up to something like 60% of the S&P 500 before you really start dealing with consumer spending. Whereas on the other side of the ledger, the C plus I plus G plus net exports, about a little less than 70% of that is just consumption. This is a very different recession in many ways for 2 reasons. One is that it's particularly hitting the service sector versus the productive or production sector, manufacturing sector. And for the US, that's very different because about 90% of our economy is service oriented. And usually services tend to be much less volatile than manufacturing. But obviously, given the nature of the pandemic, it's quite different this time with the lockdowns. The other thing that's quite different this time around is that the biggest decline in spending has been at the top quartile of wage earners. There's a website called tracktherecovery.org, which is based out of Harvard. And there's a professor there by the name of Professor Chetty, who's looking at zip code data. And what you're finding is that the top quartile of wage earners are actually, they're the ones that are resulting in the significantly lower spending and the weakness in GDP. And that's largely because there aren't outlets for them to spend the money. The amount of fiscal and monetary stimulus that's been provided remarkably has allowed the bottom quartile of wage earners to spend a little bit more than they did last year, which is, again, very, very different than kind of a normal, a normal recession that you have here. If there's a problem with it, it's really that, and this we'll get into the Q&A, is, how much of this do you have to keep doing for this to turn around? And that it's very easy to get yourself into excessive or very accommodative monetary and fiscal policy. But politicians are largely put on earth to give stuff away, not to take it away. And that's going to be that'll be the hard part, kind of moving on. I think, and we can show you this, I think there's a chance you're going to get a big rebound in economic activity in 2021. You're talking at 4 o'clock today, you'll find out. It looks like Congress is circling around some sort of stimulus package. It's skinny down, if you can believe it, to only maybe $1 trillion, which is about I don't know, it's about 5% of GDP. It could be 500 billion, it could be 750 billion. But if you combine that at an annual rate, that's about 10% GDP, 10% GDP growth. You combine that with more confidence and the vaccine and opening up, you could have a very, very strong rebound next year. The issue, and I just wanted to show this to you too, is that we're still about 10 million people short in the labor force, non-farm payrolls, than we were in February. So in February, we had 150, just use round numbers, 153 million people in the workforce. We dropped down to 130 million by April. And right now, I think it's 142.6. I could be off a little bit there, but you're 10 million people short, which is going to be tough. It could take a couple years before we get back to that level of employment, and that suggests you're going to have to do more fiscal and monetary stimulus. I wish I was with you all in Georgia and Atlanta now. I'm sure a lot of you have kind of OD'd on politics. I know I have. But what it looks like now, by the way, is that you have a Democratic president and a Republican Senate. And this is good, if you want to start a fight with somebody or it's good bar talk or something. But that hasn't happened since Grover Cleveland. That's right here. It hasn't happened since 1884, 1886. And if you really want to get into an argument with somebody, you could say Grover Cleveland was also the last president to be elected president twice, but in non-consecutive terms. So he won, he lost, and then he won again. And so whether past is prologue, we'll see. I don't want to get into too much of politics here. I guess I don't want to offend anybody. I'm speaking from a very kind of, very much of a parochial point of view as far as what's good for the market. I'm very pleased personally that it's very likely that we're going to have divided government. And of course, we don't know what's going to happen on January 5th. I'm kind of going with the betting odds as opposed to the polls. That served me very well in the general election. I'm hoping we have divided government personally, and that's largely because the blue lines here are the projected plans for Vice President Biden in terms of taxes, and this is corporate taxes, income and payroll, small business, capital gains, dividends, all the rest of it. And the red is kind of where we are today. And again, we could have a discussion about what's good for society or all the rest of it. But as a market person and an economics person, it's just hard to see that being a particularly great development for the market. So I'm kind of all for divided government, in my own opinion. I'm just going to show you one or two more things, Adrian, and then I'll stop talking. But the other big issue, I think, as I kind of foreshadowed before, is just how do you dismount from such a high wire act of, our budget deficit last year was $3 trillion on a base of about $19 trillion in economic activity. So, you're looking at 16, 17, 18% of GDP if you include our trade deficit as well. And so twin deficits, 18% of GDP, you haven't seen anything like that since 1942. Of course, the Fed is throwing money at the problem. The assets on the Fed's balance sheet, this is a chart of the size of the Fed's balance sheet and the velocity of money. If some of you might remember this term, pushing on a string, but this is a little bit pushing on a string. We're throwing a lot of money out there, but it's not really getting into the real economy, or it's largely getting into financial assets. And I say here, quantitative easing, QE, may be better for markets than it is for people, because if you're just an average person and you have a savings account but don't maybe have enough money to have stocks and bonds, you're not too happy about 0% interest rates. Whereas if you're a wealthy person and you have a lot of stocks and bonds, this has been pretty great. And we've been doing this since 2008. It brings up a lot of interesting questions, I think, about fiscal and monetary stimulus. I'm just going to show you one or two more things very quickly. One is this is active versus passive. Very interested in how people answered that question about whether they put more money to work. One of the things I would just tell you here, and I'm going to stop on this slide, is that one of the things that worries me a bit about what's happening right now, and I would say I'm broadly pretty bullish about certain stocks and certain areas of the market. One of the things that worries me a little bit now is that if people are piling into passive investments, like the S&P 500, the main thing they're trying to purchase, which is diversification and lower risk, is not really being fulfilled by that purchase. If you can believe it, 1% of the stocks in the S&P 500, 5 stocks, make up about 23% of the index. And so for those of you who are on investment committees or in the investment business, obviously you would have some problems explaining that to your committee or your consultants if you had that much concentration in your portfolio in just 1% of the holdings. And obviously the stocks aren't particularly cheap either. And you're seeing Tesla and all the rest of it that's going to join the index. So it brings up other questions. And my own opinion, And of course, I'm biased because all my clients are active money managers. But my own opinion is that active is going to be a better place to be than passive if I'm looking over the next 10 years. Let me stop there. And there's other stuff in here about winners and losers and all the rest of it. But Adrian, I know you have a lot of very thoughtful questions, so I'm happy to just answer them.
Thank you, Jason. That's very helpful level-setting set of facts and one or two opinions. Let's get to the issue of inflation. And you talked a little bit about the extraordinary measures that the Federal Reserve have taken to bring relief to the economy, not just in 2020, but really since 2010. And yet inflation has persistently fallen short of the Federal Reserve's target. Next year, as is the tradition in our club, Atlanta Fed CEO Raphael Bostic will be giving us the Fed outlook. Can you spend a minute or two on Treasury Secretary-elect Janet Yellen and her background and what her agenda might be? And what are the potential consequences for inflation? Can we afford to regard it as something, that's not imminent?
I think, Adrian, this is a very thorny question, in my opinion, for everyone on this call. I really believe inflation, and this may be true of any forward 10-year period, but I think it's particularly important now. I think it is the single biggest question, which is whether all of this fiscal and monetary stimulus will result in inflation over the next 10 years. I would say in the short term, let's say the next year or two, there's no question the pandemic is manifestly deflationary, right? Because of its impact on the labor markets, because of its impact on rents, commercial real estate. But over the long term, normally spending lots of money you don't have, especially if you don't have tons of domestic savings, we've seen that before. That's about as old as humanity. And if that worked consistently, we would do that all the time. Now, I know we have the consul from Japan on the line as well. And Japan has been able to do that without inflation. But I think the U.S. is very, very different than Japan. We do have the benefit of having the reserve currency, but we also have a very diverse population, very diverse economy that, in my opinion, is unlikely to stand for long-term deflation. And this gets a little complicated, but I'm convinced that the populist movements we've seen in this country on both the left and the right are largely a result of having lower inflation for a long period of time, which is a very slow economy since the financial crisis. And I think Donald Trump, in many ways, is in some ways a symptom of that, where the policy mix that we've had, I would argue, just like that chart I showed you on the Fed's balance sheet and the velocity of money, I think you could argue that many of these policies have tended to be better for wealthier people than they have been for average people. So I'll just leave it there for a minute. As far as Janet Yellen is concerned, I've met her a number of times. She's a very, obviously, she's a brilliant woman and has all the right qualifications. She has a different point of view than I have, which is to say that monetary policy can solve a lot of problems, which is to say, social justice and climate change. And I'm extremely skeptical of that. I think it's, as Clint Eastwood said, a man's got to know his limitations. And I think having a former Fed chair as Secretary of the Treasury suggests to me you're going to have a lot more deficit spending than would normally be the case.
Yeah, it certainly seems like deficit spending or modern monetary theory has become somewhat closer to the consensus. Let's pick up on a theme you touched on a moment ago, and it was interesting for me to see your slide about in the services recession, whose spending dropped the most. You were very prescient with your call over a decade ago about the forgotten man. I think that's a metaphor you use to warn about how marginalized our middle class in our country had become after not, benefiting from globalization and feeling betrayed by the promises made by Washington institutions and the so-called elite consensus. As we end the year looking ahead, expectations are for the economy to reopen and continue to recover. But the great lockdown has still left the ugly scar of an unemployment rate of around 7%. And there are some signs of permanent job losses, reflecting a widening gap in participation in the recovery. Outside the purview of trade policy and resetting our relationship with China, is there anything you anticipate the next administration might do to help our economy invest for tomorrow today, to help our middle class participate in the recovery better?
Yeah, Adrian, it's a great question, and I don't want to. By the way, I think the forgotten man that was coined by a Yale professor named Sumner, and then Amity Shlaes used it for a great book on the Great Depression. But so I've adopted that as well. But I don't want to claim credit for that. But I do feel very strongly, and I have talked a long time about how I do think a lot of very top-down policies, and people, I'm sure you're getting a sense of where my politics lies, but I do tend to think a lot of top-down policies, they tend to benefit people who are well-connected and people who have political power. And I think I'm a small businessman. We have a business of 50 people, and I think we're able to stay open. And we haven't had a big impact on our business, thank goodness, in terms of our ability to get revenues and be profitable and pay our people, and we haven't had to lay anyone off. But we're just blessed in that way. I have many friends who are small businesses who are not so lucky, who own restaurants or have an optician store, or all the rest of it. And so one of the things I really hope is that this fiscal stimulus package that's being discussed, and again, at 4:00 today, we should have a better idea. I really pray and hope that there's something in there to keep small businesses afloat. And of course, I'm not quite sure what the situation is like in Atlanta, I have to say. In New York, it's pretty grim. Starting today, there's no indoor dining and all the rest of it. Of course, it's like 35 degrees outside here. And this is a period of time, obviously, where New York really comes alive for Christmas and all the rest of it. And so that's one of the things I really hope, because small businesses, generally speaking, and I know this sounds, I'm not stumping for anything, I'm never going to run for office or anything, but small businesses are statistically a big driver of employment. They're, very large businesses tend to be, in terms of their net contribution to new employees, they tend to be net about flat. Let's say if you're talking about companies over 1,000, it's the companies between 10 and 100 that generally tend to provide the biggest increase in jobs. And that's one of the things I'd like to see for next year. Now, there's an argument that says, well, that, if one restaurant goes out of business, there'll just be another one that comes after it. Yeah, maybe. But I also think, I have a lot of empathy for the people that put their blood and sweat and tears in businesses and the equity and all the brand that they create. And so you want to continue to create, I would say, incentives for people to take those risks.
Yeah, I think that's very well said, speaking as a small business owner myself. So what do you think are the long-term lessons from the COVID era for policymakers and businesses? I mean, do you think that there are any open-ended questions as we begin to distribute and hopefully adopt the vaccine? I think I saw a bullet point on your first slide suggesting that the black swan, or the unexpected rare high-impact event, was not the pandemic itself, but the decision to lock down the economy. What do you mean by that?
Yeah, and I think, for the people on the line, feel free to send me hate mail. I'm kind of used to it. And, I get a lot of credit. Adrian will tell you, I get a lot of credit. I'm very lucky in a way, because I can be provocative, and, I don't have the responsibility of like running the country you can bring up these questions and not be obviously on the hook for people's lives and well-being. But I do think in the fullness of time, I think there's going to be a real debate, because I spent a lot of time reading economic history. I think there's going to be a real debate about the wisdom of such a, for lack of a better term, unnuanced approach to dealing with the pandemic, which is to say locking everything down. And I think in the initial stages, it made a lot of sense from a health perspective, clearly, because of the impact on our health system. and the possibility of our health system not being able to deal with the virus. But I think as time went on, and the study of economics is largely about the study of cost benefit analysis,
Right.
And you're trying to allocate scarce resources. And so I try to take a look at the costs as well as the benefits. The benefits, I think, are clear of the lockdowns, right? Which is to say that I'm sure we saved a lot of lives by the lockdowns. The costs, though, I don't think have been, are only now starting to be properly started to think about in terms of impact on mental health, impact on children, impact on small businesses, not just economic costs, but just costs to humanity. And I think, one would hope, from this, that globally, or at least in the United States, we have a more nuanced approach to dealing with something like this in the future, because this is, again, and maybe a little bit the fact that I am in New York City, and I've got a front row seat on the kind of the good and the bad. There's not a lot of good that's come out of this, but of some of the other costs to the lockdown, let's say, here in New York.
Yes, it's going to be interesting to see how history looks back in the next 3 or 4 years about how we chose to handle it. I'm starting to see some audience questions come in, and the first one touches on the theme I think you touched on in your slides about the index concentration in a handful of large companies. And so clearly the technology sector has been a clear winner in this particular year, and seem to have disproportionately benefited from so many businesses pulling forward investments in technology, truly game-changing technology. The question really is around what was touched on in the Mentee poll about regulation. Some have been worrying that these companies are starting to dominate their markets in a way that are threatening competition. A couple of weeks ago, we had a program about the trust-busting presidency of Teddy Roosevelt. Do you think that's on our agenda in the near future? And how do you think that will impact their willingness to continue to invest in the future and generate the productivity growth our economy so badly needs?
Yeah, and that's a great question, because I think social media is a bit different than, let's say, social media is, I think, kind of sui generis, right? Because it has such an outsized impact on the culture, has such an outsized impact on our political system. And I think when those companies tend to take political stands, in my opinion, as a shareholder, that worries me. Because regardless of how valid you might think their political stands are, I'm a little skeptical as a shareholder of companies wading into some of these political questions, mainly because I have an office in Washington, D.C. We spend a lot of time thinking about Washington's influence on business. We also have an index, as you may know, called the Policy Opportunities Portfolio, or it's a lobbying index, where we've looked over about 18 years at the impact of companies that spend a lot of money on lobbying, and we've looked at their share prices. We created this index. Trump broke the Policy Opportunities Portfolio, and it's come roaring back in the last 4 weeks, by the way. So it was underperforming year to date through November 3rd or November 4th, and now it's coming roaring back. And I think that I guess what I'm getting at is those companies are going to be under a lot more scrutiny from both the left and the right, I think, given their impact on social issues and all the rest. I do think, and this is tangential, but I do think it's important. Milton Friedman, who I know there's a lot of revisionist history now and all this stuff about him, but he was very clear that it's a myth to think that or that big government is not good for big business. His view is that big government tends to be bad for small business. That large government's good for big business because big businesses tend to have the resources, they have the lawyers, the consultants, the lobbyists, all the rest of it. They get the rules in their favor. Technology, Silicon Valley, and the social media companies, virtually, you may or may not know this, but up until maybe 5 years ago, they had very little presence in Washington, D.C. And now that's changed big time. Now they're spending an awful lot of money. So, which has, money talks, right? So, but I still think it's almost, given their power, I think it's almost unavoidable that they're going to be under a lot more scrutiny.
Yeah, I know it's very often a triumph of hope over reality. Let's hope for some smart regulation.
Yeah.
Another question from the audience is relating to, I think, a slide that you might have glossed over at the outset, which is, who do you think, or what do you think are the long-term winners and losers from the great pandemic?
Yeah, and if I can use my handout again, I might just go. And this, I wrote. This is, and I'm not going to spend a ton of time on this, but this, I wrote this in March and April, and I would say sometimes you write these things and like, you want to forget that you ever wrote it like 2 weeks later because it's just all wrong. And, but this for the most part, I think is held up pretty well. And I think, listen, I mentioned nationalism and populism. I in my opinion, that's an enduring theme for this, because there are real questions about experts and government confidence and all the rest of it. And that again is a equal opportunity. It's on both the left and the right. I do think gold and hard assets are going to be beneficiaries, are going to continue to be beneficiaries of this, because there will be real questions about the integrity of the dollar. And I think in terms of losers, I would just say, the two that I have here that I want to talk about, and we could get this off the screen now, but I think China, China is one where I think you have to put a big question mark next to, because I think while President Trump's view of China was seen as very much outside the mainstream 4 or 5 years ago, it is now closer to elite and popular opinion that China may not be the friend or the partner that it once was. And I think China's brand in many ways it's hard to believe how different it is than it was 4 or 5 years ago. And so that will have an influence. I think that has other implications perhaps for globalization. I also think, I do think, because I'm very interested in education, because I think it has so much to do with productivity, and has so much to do with, obviously, child development and the way an economy looks in the future. And I do think there's a real question about high-priced college education now. That is something that's been brewing for a long time, but I think this crisis, again, in the fullness of time, people are maybe look at this and they might say it's a hinge moment where people really started to think about what they're paying in relation to what they're getting in return. Are they really getting well educated, or are they just getting a credential? Or are they getting an education that helps them compete in a new economy, or is it just bragging rights or something? So I do think that's a long-term, a little different one of the losers, I think, that could wind up being true, or people may start to think about that.
Yeah, certainly a significant hinge moment. It's going to be interesting to see how the higher education industry adapts and pivots after this particular pandemic. Here is a predictable question. How do you think it all unfolds in the UK with the Brexit and the European Union over the next 3 to 5 years?
Wow, I'm going to.
I mean, we've only got 5 minutes. Can you?
Yeah, you're lucky. I'm lucky that you only have 5 minutes, because I don't know. I think that I think in many ways the Brexit movement is I think it's a close cousin to Trumpism in the United States. I think it has a lot to do with an idea that globalization, if pursued too quickly, can have losers attached to it that oftentimes are not close to power. And you have to be careful. It's a very delicate balance, because I'm a very free market person, I have to say, because I think that's the best way to allocate resources over a long period of time. Free markets tend to do better than social planning. But I think I really don't know. I have a feeling, though, the UK at the margin, after an initial hit, may start to do a bit better. I also think in terms of what I'll be watching most closely is really the currency, because I'm of the view that one of the threats to the ECB, I think, is really this tension between the North and the South in terms of using government deficits to fill holes in economic activity, and we'll see. The tensions can go both ways. There could be a lot of tension on the North to help out the South, and there could be a lot of tension on the South that they're not getting enough help to get their economies, in line and able to compete on a global basis. So we'll see.
That sounds like a hedged answer. It's going to be
totally
interesting. It's going to be interesting.
Really
I'll call you out on that. At least you're saying you don't have any idea. Yeah. All right. Here's the final question. Jason Trennert, you're Treasury Secretary-elect, and you're king for a day. And let's tie it back to our theme of investing for tomorrow today in an efficient way. You've touched on how important entrepreneurialism is to the mojo of the economy and how small businesses create jobs. What would be your policy priorities to increase the level of investment in our economy and to turn that into productive economic growth?
Yeah, Adrian, that is a very complimentary question. I'm humbled by it. It maybe goes back to just my general philosophy, which is I tend to, I think about the Hippocratic Oath, which is first do no harm. And I tend to think, for the most part, free markets tend to do a better job than panjandrums in Washington, D.C. And so one of the things I hope, let's say, Janet Yellen doesn't do is reinstitute a lot of new regulations, particularly on the banking system and other parts of the economy, at a time when the economy, in my opinion, is still fragile. The economy's come roaring back, but you have to remember it's come roaring back because we've spent $3 trillion of money we didn't have last year. We spent $3 trillion of deficit spending on a $19 trillion base. It's not hard for the economy to come roaring back if you do that, but that is not a sustainable approach. And you're going to need the private sector to help you. It doesn't mean that you're opposed to all regulations at all, right? You need the rule of law. You need people to be safe. By the same token, I think you really need to have the banks involved in the recovery process. Otherwise, you tend to have a lot of non-bank entities filling the void, which oftentimes are less regulated than the banks themselves. And so you're just creating another problem. So that would be my biggest issue. And I also I'm a little bit of a Laffer curve guy, and I'll end on this, which is to say that there's no way you're going to balance the budget through higher taxes. It's the real fundamental issues for balancing the budget over the long term, as we all know, tend to be things like Social Security, Medicare. Those are interest on the debt. Those are things that require real structural changes they took a long time to create those problems. It's going to take a long time to solve them. And so I would take a very long-term approach to dealing with them, as opposed to kind of seeking some sort of pound of flesh from, wealthy people, however that's defined. And I just know from around here, the millionaire's tax in New Jersey starts at like $400,000, so that once these things get, they can get a life of their own. And before you know it, it's not doing precisely what you wanted to get done in the first place. So that would be my answer on that.
Well, I appreciate that. And perhaps one of the things that 2020 has pulled forward is the debate about entitlement program reform and the grand bargain we made in the 1960s, given the unpleasant fiscal arithmetic ahead of us. Jace, thank you so much for all these facts and for one or two provocative opinions. You've given us a lot to think about. I'm going to hand it back now to President Carr.
Thank you.
Great. Well, Jason, thank you very much. Just wonderful conversation. Adrian, well done on moderating. You guys covered a lot of territory. Jason, I did have one follow-up question, but I do want to say, I've certainly read a lot of your work and your team's work at Strategas, and certainly seeing you on CNBC. Slowing it down and just having a conversation with you is awesome. So,
well, you're kind. No, thanks. I wish I was there in person. I might invite myself to the cocktail party tonight. I don't know.
Yeah, well, it's tomorrow night, but you are welcome.
Tomorrow night.
And we
I don't know.
we will have you back. We will have you back in the future. Just curious a little bit. Hadn't talked on it yet, but there is a lot of cash on the sidelines. I'm just wondering what you hear from clients that you speak to. Where do you think they ultimately are looking to put it to work, and when do you think they what makes them comfortable? Is it as simple as the vaccine?
It's a toughie because obviously our clients are institutional investors, and the hard part is that I think people want to buy the cyclicals and the more value-oriented industry groups and names, right? They want to buy airlines and cruise lines and hotels and casinos and all those things because they're very cheap. I think the problem, though, is that you're probably looking at another couple of months of pretty grim economic news, right? As you're getting the vaccine rolled out, and it takes time for the fiscal stimulus package, Lord willing, to get that through. So I think people have been hesitant to put a lot of money to work. Technology clearly has been a big beneficiary of this, but the 5 stocks I showed you are actually trading a lot cheaper than a lot of small cap cloud companies and all the rest of it, which are trading at very unusually high valuations. And I don't find there's a big appetite to put a lot more money to work there unless people are really speculating. And I think one of the reasons why I wanted to ask that question, and thank you for allowing me to ask that question, is whether people put more money to work, is that I find encouraging. If that number were 80% said I put more money to work in the stock market this year, I'd be more nervous. I just think the big question next year will be this rotation from growth, very growth-oriented companies, to more cyclically and value-oriented companies, perhaps financials, maybe basic materials, industrials, industries like that.
Well, wonderful. We will certainly see how that plays out. But we are at the top of the hour. I'd love to keep you for more questions. We'll let you go. Thank you for spending time with us today. Adrian, well done on moderating. And Jason, you're welcome back anytime.
I look forward to it. I look forward to it in person.
That'd be great. We look forward to it.
Thank you.
All right. Well, thank you both.